Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market update. So in today's markets, guys, traders seeming to have discounted yesterday's CPI news all but completely as the markets made a very beautiful recovery on the day. SPY up 0.91%, QQQ up 1.09%, and even your Russell growth stocks after a almost 4.5% decline yesterday, up almost 2.5% today. So what exactly happened on the day, guys? Well, there was no macro news to spark such a rally. We do have producer inflation data coming out tomorrow morning, so we'll be curious to see how that comes in line. Just a quick reminder, last time we got producer inflation numbers last month, they were extremely bullish, showing that suppliers had net decreases in overall prices, which was benefiting companies being able to have higher margins as they're paying less and less for supply costs and may not have to increase prices for consumers as a byproduct since they're benefiting from that reduction in the cost of their supplies. Well, they now can have excess margin on the bottom side and don't have to necessarily increase prices to the upside to consumers to make up for high supply costs. So producer inflation will be a very important number coming in tomorrow, which could help even fuel the rally more if those numbers come in low. So we're going to do a quick recap here, guys, of exactly what happened in the markets today. We also have two earnings presentations for you guys today in the names of Moody's Corporation, and number two is going to be Shopify. Not that many earnings left on the table here, guys. Tomorrow we're going to be doing pretty much Coinbase, John Deere, and Trade Desk, just a few that I do want to be looking at. And then on Friday, we'll probably have some recaps of some that I didn't have time to cover. I do want to take a look at Applied Materials, and potentially we'll do some dives into names that we haven't covered over the course of the week, potentially some Datadog as well. So we're going to be covering those more on Friday, and I may even get into a little bit of Marriott because I really want to present to you guys a few of the leading hotel chains and how they're doing and how they see the consumer doing as well for the foreseeable future. So we're going to do those earnings together. Then we're going to go through our major technical analysis on our indexes. Then, of course, our major tech stocks. And lastly, to wrap it up, we're going to take a look at my portfolio at the midpoint on the week and see how we are performing this week. So without further ado, guys, let's get right into it. So SPY QQQ up very nicely. In terms of the heat map, this is a very stark contrast from yesterday's trading. You might remember this heat map yesterday where everything was red. Well, today, completely the opposite. Pretty much everything in the green, except for Apple kind of lagging slightly behind, but very beautiful recovery nonetheless across the board. On the one-day relative, you'll see this as well. Yesterday, everything pretty much in the red, but now everything coming back nicely in the green, except for your consumer defensive names. And on the one-week relative, where do we stand after the CPI mishap yesterday and today's rally? Well, still a fairly mixed market here, guys, led by technology, industrials, cyclicals, communication services, and financials and healthcare to the upside, but you do have the bottom half of the market, which is a bit more exposed to higher interest rates. And whenever news comes out like the CPI yesterday, which could hint to rates being higher for longer, well, those have obviously underperformed since then. We're talking about real estate, energy, utilities, defensives, and some basic materials. So what exactly happened here, guys, today, right? So we were looking for the bears' inability to follow through after large moves to the downside. This happened on the FOMC day, V-shaped recovery to all-time highs. CPI yesterday, looking like the bulls want to V-shape this again. And this has been a story now for the past couple of months, ever since your November rally, the bears' inability to capitalize on momentum. You see here, most recently in the end of December, where we lost the daily uptrend, breaking this higher low right here, setting a lower low. Could the bears capitalize and set the daily downtrend? No, they just allowed the bulls to completely roll them over back to new all-time highs. So we haven't really had any daily downtrends since pretty much the month of October. Now, just a quick reminder, guys, what exactly happened back here in the month of August, September, and October? It might be a long way away now, but we did cover it on the channel. This was the period in which inflation was starting to rise after a very hot summer for the consumer. Obviously, during the summer times, it's seasonal spending. And consumers were out and about spending their hard-earned money, which did lead to an uptick in inflation. And then the Federal Reserve really got hawkish a lot in the August-September meetings. They were very hawkish, and this is where was our first mention of higher for longer. Prior to this, traders were expecting rates to come down pretty much in December. But here is when the Fed said, no, December's too soon. We're going to have to push it in to the first half of 2024. And the markets really didn't like that. So you had a net uptick of inflation. We saw this right here, as you can see. After June, July 3.2, boom, August and September 3.7 before finally tapering back here at the mid-October point. And now we've consistently been on the downtrend since then. So bit of a mixed market currently, right? So traders really discounting what happened yesterday, but there's a few easy reasons as to why, and we were explaining that in yesterday's video as well. Number one, guys, the economy is healthy. The GDP numbers that we've shown on the channel shows that the economy is strong and robust. Number two, the jobs market is also robust, and Jerome Powell also commented on this a couple Wednesdays ago during the FOMC meeting right here, where he said that the jobs market is very robust, the economy is very robust. As such, they are not likely to get crushed by high interest rates just yet. Obviously, they don't want to overdo it and keep rates too high for too long. But nonetheless, the economy performing well despite the high interest rate environment right now. And reason number three is very simply because even though yesterday's read, we were expecting 2.9, and yes, we did get 3.1, but it is still on the correct trend to the downside. So everything was not bad with yesterday's CPI report. If anything, it opened up the door for true bears and true short sellers that are of the narrative that rates should be maintained high for the entire course of the year and that inflation may very well come back. Well, if they truly believed in that narrative, guys, we would have at least seen some follow through, but seems as though institutional and retail investors alike just don't believe the bearish narrative that 2024 is going to be a very bad recession as a whole. Now, keep in mind, we do have seasonality, which I have been showcasing on the channel for the past couple of weeks. So midpoint of February, usually you tend to get a drop off, and that coordinates this moment in time with today's trading and tomorrow's trading. So could still be in the cards. Fear and greed index, the market is still greedy, and the seasonality usually after February, after that February drop off, does stay fairly weak into early March. Now, keep in mind, since we're pretty much through earnings season right now, there's really no more bullish catalysts for the market. We only have a few jobs reports remaining here over the course of the month, and we don't have any CPI readings before next month either. So there's really a lack of bullish positive catalysts to be had in the market. No earnings, no CPI, no Federal Reserve meeting. So in terms of the broad market events that move the market substantially, we're kind of out of those until at least the end of March at this point. So that is why it's very possible that the markets may take some time to have a little bit of a breather. But are we expecting a heavy drop? No. As we were saying in the channel, guys, could be a very shallow weekly pullback into end of February, early March, as we make our way through earnings season here, and as our markets on the weekly timeframes at least are just ever so slightly overbought. So continue. But in terms of the actual technicals, guys, we'll cover exactly what happened during the day and what the expectation is for the rest of the week, maybe leading into next week as well. We'll do that after we cover earnings. We're going to do earnings right away, and we'll be going over these fairly quickly as well. So company number one is going to be Moody's Corporation. Now, I've talked about this one a lot on the channel. I always bring it up when I bring up company names like SPGI and MSCI, those two which we've reviewed in the past couple of weeks as they've had their earnings. And now it was time for Moody's to have their earnings, which they reported Tuesday, pretty much Tuesday morning, I believe. And as you can see, guys, the stock has sold off significantly from their earnings, now down about 10%. Very nice discount on Moody. So beautiful monthly uptrend right here. Just looking for the monthly higher low confluence with our support level right around here, guys. 350, 355 is going to be that level. And I may actually be picking up some shares of Moody's off of this beautiful discount here. Now, what was the reason for the decline? Well, they missed, but they missed ever so slightly. So a little bit of a miss here on EPS, 6% to the downside, which did kind of hinder their end of year EPS results as well. So they missed on the quarter basis, which did cause them to miss their end of year segment as well in terms of EPS, and an ever so tiny miss on revenue. But what do I like about the company, guys? Well, if you guys don't know, MCO is Moody's rating agency. They have two businesses, okay? Number one is going to be Moody's Investor Services. That is whereby they rate everybody else's debt. So corporate debt, government debt, a bit of the same business that SPGI has as well. SPGI, S&P Global, and Moody's are the two largest debt rating companies in the world. So whether you're a government entity or a corporate entity, you need to go through them to get your debt rated to be able to offer it onto public or private markets. markets. And the second business that they have is called Moody's Analytics. They provide data analytics for financial firms across the world and government entities as well. And obviously, those two businesses are very high margin businesses. So I like them. They have a huge moat. It's very difficult for new participants to enter this line of business. It's basically a monopoly right now between them and S&P Global for the debt rating pretty much. And they also have very high margins. You can see down here that on a yearly basis, they're always putting in anywhere between high 20s to mid 30% net profit margins, which is extremely good. And this past quarter was just pretty much the same, a little bit lower net margins for the quarter, about 23%, but still good nonetheless. They have very decent free cash flow as well, which allows them to do a lot of share buybacks. So positive free cash flow, very good EPS growth, 15% guys over the next 4 years. That is substantial for such a large company as well. Revenue growth is healthy as well, between 9 and 10% for the next couple of years. Their debt repricing pipeline through 2027 is absolutely massive. So many companies and institutions will need to reprice or refinance their debt. And to do that, they're going to have to get their debt re-rated by these agencies. This is something that came up in the S&P Global earnings that we just looked into the other day. So this should provide them a very healthy revenue stream over the next couple of years. And their PEG ratio is fairly good as well. So if we just take their earnings per share through 2024 and divide that by their current price to earnings ratio, their PEG ratio is about a 2.26. I always like to see them between 1 and 2, but I would not mind buying this company as close to 2 as possible. I do still think it represents some very good growth opportunity. Now, 2 is a bit high, but keep in mind that this is a very solid company, and solid companies usually do trade at premiums in terms of your PEG ratio multiples. So I would not be opposed, even if it is over 2, to be paying for that for Moody's, just because of their revenue expansion, their EPS expansion over the next couple of years. And now that we're getting a fairly decent share discount price after their earnings, would not be opposed to picking a few shares up down in the mid 360 level. Any which of these three companies are on dips. Take a look at Moody's, take a look at S&P Global since their earnings. They're also on a dip, right? Retesting this monthly higher low, previous support around 400, 410 as well. And you take a look at the other one, guys, right? MSCI, we covered those earnings too. MSCI also coming down into a little bit of a dip, breakout, retest of your previous support resistance, which is now support, 556. Any which one of these three companies is the easiest purchase in my life that I could make, guys. Those companies simply just go up over time. They're too well established. They make too much money to be going anywhere, and they usually always outperform the S&P 500 on a year-to-date basis every single year for the past 10 to 15 years at this point. So let's look into Moody's exactly, and I'll deliver a bit of a better expectation as to what they do through their investor presentation. So here we have the full year highlights. Very, very nice. Moody's delivered fiscal year revenue growth of 8%. Very, very good. Their MA division, which is the Moody's Analytics division, achieved an annual recurring revenue rate of $3 billion. That is huge. This company makes $6 billion a year. So this is half of their business, and it is a recurring revenue business, is exactly what you want to see. Up 10% with strong growth from all business lines. Their Moody's Investor Services, their debt rating agency, revenue grew by 6% in 2023. Very, very good. 2024 revenue expected to grow in the high single to low double-digit percentage range. So even better next year than in our current year. That's exactly what you want to see. They also are going to return $1.6 billion to shareholders in terms of share buybacks and dividend payments. Very good as well. And for your fiscal year 2024 guidance, you have an EPS range. Let me just go down here. Let me move myself over again. About a 24% increase from 2022 as a whole. So looking very good here, guys, for Moody's, just in terms of their financial snapshot. Now let's take a little bit of a further look into the business. A few things that I do want to present to you guys, right? So they have a lot of industry recognition, 150 plus awards in 2023. Very solid business. Take a look at why. How much of the companies do they do of the top Fortune 100 companies in terms of relationships? They have business relationships with 97% of all Fortune 100 companies, and 87% of the Forbes 1,000 companies are Moody's customers. Absolutely amazing. It just goes to show you guys the moat is real, and companies have no choice but to really go through them, right? So I just want to present you guys a little bit of extra guidance here, right? So here is your fiscal year 2024 issuance guidance. So this is going to be more likely for their their debt rating services, right? So total issuance that they're going to give is between the mid to high single digits. That's very good. We saw that they were growing at about 6-7%. So now they have a little bit of an increase on this, and you can see all across the board, pretty much, except for financial institutions, they will be having a lot of business in their debt rating agency over the course of the year. Very, very, very good. Let's take a look at their full year guidance here. Revenue, once again, going to increase in the high single to low double digit percentage range. Very good, right? And then their operating expenses. Is their revenue going to grow faster than their operating expenses? Yes. So high single to low double digit range. Let's just call it 10%. Operating expenses, mid to high single digit range. So let's call it 7%. So there is some operating leverage. The company continues to grow revenue faster than it grows their operating expenses. Extremely good. Operating margin also is going to be standard. That should bring them about anywhere between 27 and 33% to the bottom line, depending on their miscellaneous expenses. So that is very good. And once again, free cash flow positive, about $2 billion is expected, which is going to lead them to buy back an additional $1 billion worth of share. Extremely, extremely solid company here, guys. There's really nothing bad to say about this business as a whole. And once again, their Moody's analytics business this time. We took a look at their investor services, the debt rating, their analytics division, double-digit revenue growth, and strong margin performance in their fourth quarter. So you can see this extremely healthy, right? 10% revenue growth and operating margin expansion as well. Exactly what you want to see. And here you go, the full breakdown, right? Between their lines of business here for their analytics division. Everything performing very good. That's what you want to see. All lines of business growing in the right direction here, guys. So full year 2024 forecast, right? Their total MIS rated issuance, so that's going to be their debt rating issuance, is going to grow still in the mid to high single percentage range. Exactly what you want to see. Very, very nice. High operating margins. It's just pretty much more of the same, right? We can just go through this entire investor presentation and it's just going to be pretty much more of the same. I just wanted to showcase that the company is solid. All lines of business are growing and all lines of business have extremely high operating margins. You really can't go wrong with a company like this, guys. So I will be heavily looking to buy some shares, guys. I'm going shopping for either one of these three companies, right? Either Moody's, SPGI, or MSCI. You know, if you're trying to pick a favorite between the three, you're really just nitpicking. In my opinion, SPGI is the more well-rounded company because they have a more diversified, lines of business within themselves. MSCI is more focused on only their ETF holding generation, right? Any issuance that they have on ETFs, they collect obviously the management fee. MSCI also has their data analytics division. Moody's on its own has an analytics division and a debt rating agency. S&P Global has all of that combined into one company, okay? So they have data analytics, they have the S&P suite of ETFs as well. They also have the debt rating business too. So it's a more well-rounded business. It really encompasses all three, but you really can't go wrong. Any which of the three is a very, very good purchase. And now second company we're going to cover, guys, is going to be Shopify. So Shopify, coming down off their earnings, right? So prior to the earnings to after their earnings, we're down almost 15% on the pullback. And I did play this one with some short puts around $70, which I was able to close almost 100% in profit. Very good. But they did have good earnings here, guys. So their earnings only came down because of somewhat light guidance in terms of free cash flow. Now, why that's important is because Shopify just most recently became profitable. You'll see down here, 2023, positive net margins, positive net income, and they finally generated some decent cash flow. So this company, since it's just becoming profitable right now, the big focus is going to be on the bottom line and on free cash flow. That is what Wall Street wants to see. If they can continue on this path of profitability after struggling with it in the past couple of years, they want to see more consistent profitability and they want to see that consistent generation of free cash flow. You can see 2020, 2021 were great years, but largely pulled forward demand because everybody was at home. A lot of e-commerce was happening at the same time. That's why they had very good years. But you can see what happened in 2022 when we had that drop off from the pulled forward demand, negative free cash flow. Their debt at least is not that high, now only about $1.14 billion worth of debt. They have higher amount of cash on the balance sheet than their debt. So that's very healthy and a beautiful amount of free cash flow generation over the course of the year. Actually, the highest amount of free cash flow in Shopify's history. So very good. Shopify is looking better and better. A big problem that I had with this company last year, why I didn't necessarily want to buy buy it, even at the lower levels, guys, is they were just struggling with profitability, and they still had not sold off their logistics business, which was costing them a lot of money. So if you don't know what Shopify does, they are pretty much a middleman. They enable a normal person to start an online store and use Shopify's platform. I've used them myself. It's a great website, great company, and use Shopify's platform to build a website, put products on the website, and then be able to sell that to everybody else. And they also do Shopify payments as well, so you may not have to go through a third-party payment processor like Stripe or PayPal. So they're trying to be an integrated solution for small business owners who want to launch an online commerce brand. Now, what hurt them is they also tried to do the fulfillment side of that. So not only did they want to enable customers to start that business, they wanted to help customers fulfill those orders, kind of like Amazon, right? So they called it a last mile service, where they would pretty much be able to ship the products that the customers would be buying on merchant websites to the customers. But if Amazon's shown to anybody, it's a very difficult business to be in. It costs a lot of money, and the margins are often razor thin as you're competing on time. Now, they've since divested from that line of business over the past couple of quarters, which is contributing very positively to their bottom line profit margins. So they're finally getting back to what they do best and just being the middleman and focusing on their technology, not necessarily on the fulfillment services. So a couple little headlines here. They're finally profitable. They've been doing very good cost management, and that's in line with spinning off their fulfillment businesses that we were just talking about. Finally, free cash flow positive, as we saw in the chart, low amount of debt. They are the industry leader for e-commerce, bar none, pretty much. Well, in terms of enabling other people to start businesses online, right? Shopify is the industry leader in that. Very high EPS growth, very high revenue growth for the next foreseeable future, which gives them a PEG ratio of about 2.21. So let's take a look at their EPS expansion here. Very rapid EPS expansion. You can see how much they struggled with positive EPS in the past. Now finally starting to ramp it up. This is a 35% year-over-year growth rate for the next 3 years. Very good. And revenue growth rate is going to be about 20% for the next couple of years as well. So let's do some quick math. If you want to know how I get to that PEG ratio again, well, we just take their 2024 EPS, right? So let's take their share price, $80, let's call it, right, divided by $1.03. That gives them a price to earnings forward ratio for 2024 of 77. You may think, well, Will, that's high. Yes, but you need to consider that they're growing this very, very quickly. That's why we use the PEG ratio, and the PEG ratio divided by their forecasted earnings per share growth over the next couple of years, 35%. Their PEG ratio is only about a 2.2, right? So not that bad for a company growing just as much quickly. You put it on a common denominator, right? A lot of companies that are growing this fast, their PEG ratios are significantly higher. We took a look at some last week, and the names of Cloudflare that comes to mind, right? PEG ratios 4, 5, that's a bit too high. But for Shopify, 2.21 is not that high. I really like this company personally. If we can get back closer to the $70 level, would not be opposed to paying that price for Shopify whatsoever. I do think they're moving in the right direction. Now, they obviously have a lot of proving to do to get back to where they previously were in their all-time highs in 2021. But the company's moving in the right direction. They're finally profitable. That's what I've been waiting for, to invest in this company in a more long-term position personally myself. So let's take a look at some of the headlines here, guys. Shopify shares down after company reports light guidance. It wasn't so bad. The CFO attributed the strong results to more products being sold on its platform. Gross merchandise volume, or the total volume of merchandise sold on the platform, increased 23% to 75 billion. Very good, above analyst expectations. Shopify's light first quarter guidance overshadowed the earnings and revenue beat. The company said it expects free cash flow margin to be in the high single digits, so 7, 8, 9%. Below the expectation of 13.6. So that is what hurt them on earnings. May not be worth a 15% decline in share price, but that is the reaction, the adverse reaction that was the cause of the drop. Now, in a research note published Tuesday, Wedbush analysts highlighted that Shopify's guidance implies operating income well below our estimates and consensus. The company's forecast implies adjusted operating income of 178 million, while consensus estimates are 382. That is a big one. Operating income 50% lower than your expected forecast for the quarter. That goes and justifies as well the reason for the drop. But operating income will still be positive, so that is good, a good sign for the company. Now, Net income for the quarter was 657 million, 51 cents a share, compared with a loss of 623 million in the year ago quarter. So very good rebound by Shopify being able to be profitable. So let's take a look at a few of the highlights, guys. We won't go through too many of these, and then we'll get right into our technicals. So Black Friday, Cyber Monday. Extremely good day for them. 9.3 billion in sales, 24% up year over year. That's pretty much a record for them. 61 million consumers purchased from Shopify powered brands Black Friday and on Cyber Monday. Now, obviously not as much as Amazon, but still a very, very solid number nonetheless. Now let's take a look here. Shopify is the world's highest converting customizable one-click checkout solution. Very good. So 36% overall conversion rate. Surpasses the competition by up to 36%. Very good, guys. It's true. They have, because of the designs and the layouts of their website, and because they make it so easy for people, and because they're now a trustworthy brand, when you see that Shopify Pay icon, a lot of people, similar to exactly the effect that PayPal has on people, it just makes people feel secure. So that's why they're able to get a very high conversion rate. Shopify checkout converts on average 15% higher than others. Very, very good. The mere presence of Shop Pay on checkout drives 5% higher conversion. Very good. And when Shop Pay is used, conversion is lifted by as much as 50%. So obviously, when you're talking about online sales and e-commerce, conversion rates are extremely high. And it's just nice to see that Shopify is really working for their customers in trying to really bring the conversion rate front and center for their business. Now, let's just take a look at some of their guidance that they're going to be giving, some of their numbers now, and some of the guidance that they'll be giving for 2024. And you'll see it's fairly good here, guys. So $75.1 billion in gross merchandise volume. That is very, very high, guys. Extremely high, as a matter of fact, right? So factors driving Q4, same store sales growth of our existing merchants, continued growth in our merchant base globally. And this is what I love to see from the report. I went through the rest, but this was a strong point that they've been highlighting. Strength in their emerging markets division. So this is Europe, Middle East, and Africa, from both strong same-store sales growth and new merchant acquisition. Very good for them to be performing very well at an international level like that. 2.1 billion on the quarter here, 24% increase from Q4 2022. Very good. 525 million in subscription solutions. That's very good. 31% increase. Obviously, this is the higher margin side of their business here. 45 billion processed on Shopify payments. That is extremely good. Look at this number. GPV penetration. GPV is just Shopify payments. Penetration 60% versus 56% in Q4 2022. What does this mean? Well, it just means that out of their total merchant sales, right? So let's take the amount of people that used Shopify Pay as opposed to Stripe or PayPal or anything else, right? These are the merchants using this when customers place orders. Which payment processing software is going to be used to give that money from the customer to the store itself? Well, a lot of people are now using the built-in software that Shopify has called Shopify Payments. And you can see out of total gross merchandise volume that was done, 45.1 billion divided by your 75.1 is 60%, right? So 60% of all gross merchandise volume is being funneled through Shopify payments. So this is getting very, very large for them. A very good investment that they chose to do. It wasn't always this way. You used to always have to use a third-party processor up until about maybe 3-4 years ago at this point. And ever since they've been doing this, it's been great to really keep the customer in the ecosystem, which is extremely important there. Now, let's take a look here, guys, at their, okay, so we have a 1.1 billion in gross profit. Very good here. But what I wanted to take a look at here, guys, is a few of their numbers as well. So operating expenses, a few of their numbers for expenses. Operating expenses down. So it just goes to show you the company is trying to be as lean as possible while increasing revenue. And the factors driving this is what we were talking about in the intro of this business. Sale of the logistics business. So no more order fulfillment. Lower headcount. So they fired a lot of people. Very good. So this has been two of the major points, and offsets by investments in marketing. Fine, but at least their operating expenses are coming netly down on a year-over-year basis. That is exactly what you want to see here, guys. So very good look in terms of their total look here. So low 20% growth. Revenue still going to be about mid 20s to high 20s. So as I was saying, over 20% growth, extremely good. And the rest is pretty much more of the same. So we won't go through that, but just to show you guys that Shopify is moving in the right direction for their business. I'm looking forward to see what they can do with that. I will be a buyer of Shopify if we can come down back into the $70 handle right here. Let's call it maybe 73 all the way down to $70. I really want to get as greedy as possible on this stock. If it doesn't come to me, I won't be upset about it. I will be looking to build a position, but it won't be a very large position of me. Keep in mind for my portfolio, if I do start a position, guys, it may only be about 2-3% of the portfolio, but I'm very bullish on the company in the long term. It's just at the point, right? It's at an inflection point. Like we're trying now to really start ramping profitable free cash flow as well, and continuously ramp revenue and EPS aggressively. So it remains to be seen, can they do it? But I still think we're a ways away, guys, from being able to reach back to our previous all-time highs, which was the craze of the post-pandemic world in terms of e-commerce. Now, let's get into some technical analysis on our indexes, and then we are going to get into my portfolio to wrap this thing up. Now, so what were we looking for here yesterday, guys, right? We were looking that, okay, need to see daily, we'll just go back here. So we were in a nice daily uptrend. Let me move this over real quick. We're in a very beautiful daily uptrend that's been maintained by the bulls. You can see here, they played good defense at the 12 EMA, which we highlighted. We were looking for the daily higher low for potential trend continuation. Why trend continuation? Because your weekly bulls are in control and your monthly bulls are in control as well. So the bias was to be bullish. However, with such a significant drop in one day, we were looking, okay, now that the bears have our attention, can they convert into an hourly downtrend continuation for more than one day, right? As they've been doing, or as the bears have been unable to do. And what we highlighted, guys, is after yesterday's intraday rally and the end of the day, the bulls took back a lot of the move, setting themselves up nicely for an hourly trend change. Well, lo and behold, we got the hourly trend change on the morning and held it through the afternoon. So now the only chance that the bears have at this point is being able to set a 4-hour lower high and potential convert to the downside. For that to be notable to us, guys, they have to do it tomorrow. We would have to see a reversal of your hourly trend to the downside. Now, if we get an hourly trend reversal to the downside, I do still have a short trade idea on the table. Let's say we open like this and then potentially look and set the lower high below today's high before rolling over. That is where the short comes in. Where does your stop loss go, guys? Very, very simply, it goes above the all-time high right here. And we're looking for targets to the downside, targeting our higher low right here, 483. So there is still some meat on the bone for this trade, but just keep in mind, it is a counter trend trade idea. So if the bulls just run away with this one, don't be surprised. We are still in a very strong daily uptrend at this point. Your bulls have recaptured your short-term timeframes. Just remains to be seen. Can they recapture this entire move, or will we be due for a little bit of a rollover? In my opinion, that just depends. How long do we continue on this hourly trend to the upside? Lose the hourly trend into tomorrow and set the lower low there. I may be looking for a short opportunity, potentially looking for the daily downtrend into this area of consolidation down here. That will be more healthy weekly consolidation as well. That is the idea if you're going off of seasonality issues, right? And the fact that we're still currently at all-time highs, weekly overbought conditions as well, may just be due for a little bit of a turnaround, but it is a counter trend trade, so we have to be careful. Other than that, the bulls have now reclaimed a lot of their control that they lost yesterday on the shorter term time frame. So just be very, very cautious entering short trade positions. It is a counter trend trade. So we have to be wary of trying to pick tops with so much bullishness in the markets. Now, QQQ's also looking fairly good. Decent day of recovery today. Same thing, defending the 12 EMA nicely. So once again, not able to convert, right? The bears just have an inability to convert these downside moves into daily downtrends. We'll see. Can they do it here? Set the daily lower high into lower low conversion. We'll keep an eye on your hourly trend. Hourly trend is now favoring the bulls. If we, for some reason, lose this into tomorrow, something like this, I will want to be taking this. You see the hourly lower high, lower low. If we break this low right here, I'm entering the trade right here. The stops go above pretty much yesterday's high at this point, right? Or pretty much the all-time highs, at that point. And we're looking for the lower low here, 416. So your stop loss at that point, we should be getting in roughly around here, 433. Stop goes about 438. That's $5. And we're targeting 416, which is roughly $16 to the downside at this point. So nice little 2-3 to 1 risk to reward play. But once again, a counter trend play. Do not take these trades with money you cannot afford to lose. That is the short trade setup that I am personally going to be looking out for if it does follow through. And obviously, guys, if we just power through and just continuously previously set continued hourly uptrends, guys, well, you know what's going to happen. Most likely the bulls are going to try to V-shape this and really try to crack to new all-time highs. So bulls in full control, never lost it. Weeklies are also still looking healthy at this point, despite being ever so slightly overbought. Now, financials also looking healthy. We were really worried yesterday about the 38.27 level. If we lost this low right here, well, the bears would have engulfed your daily uptrend at that point, and we'd be looking for a potential daily downtrend setup. But it did not manifest today. The bulls able to recover nicely back above your 12 EMA. Look how much the bulls have defended this 12 EMA. Whenever we dip under it, the bulls aggressively start buying these dip, and they did the same thing yesterday. So we're still stuck at the top end of this tightening range right here, never breaking. Tried to break it yesterday, right? But nonetheless, an ever so beautiful tightening range here. What does that mean when we see a tightening range at the top end of the move, guys? It's just really sideways weekly consolidation at this point. Still no loss of this weekly upswing. However, momentum is still very strong. Weekly overbought conditions nonetheless. So we'll be looking out, guys. Yesterday's low is key, 38.43. Lose 38.43, same thing as SPY, same thing as QQQ. If you lose yesterday's lows into daily downtrends, into weekly consolidation, well, financials is exactly the same. Yesterday's low becomes the key level. As of now, bulls still in control. XLV Healthcare doing very good today, 0.87% to the upside. And XLV Healthcare has a bit of a more easy chart than the rest, right? So XLV Healthcare, 12 EMA on the daily, has been very good defense. And you saw they defended it with yesterday's close as well. So now we were always looking for the daily higher low for further trend continuation. Beautiful daily uptrend, right? Got the daily higher low. Where did it spike down into? Well, it spiked down into our 12 EMA, but it also spiked right down into our previous area of all-time high, which acted as some short-term support. And now we have bullish continuation. Bulls really engulfing most of yesterday's hourly move only today. So they are looking a lot better than some of your other indexes here in terms of your ability to engulf this back to new all-time highs. A break of 145 will obviously be just daily trend continuation at this point, looking very healthy. And same as the rest, yesterday's lows become key, 142.14. Break that to the downside. Daily consolidation and further weekly consolidation is underway. Whenever we do get this first daily downtrend, guys, we haven't got daily downtrends on any indexes since pretty much the month of October. As soon as they happen, just keep an eye out for that, guys. It will be a multi-week period of consolidation. So that is what I've been looking out for now for a better part of the last 2-3 weeks. Whenever we get that first daily downtrend, that's when you know that you can really look for a few weeks of consolidation and not be too nervous that you may be missing some moves to the downside. Usually they will have continued follow through here, and that is when we'll be really building our shopping lists. For now, things are still relatively expensive. Now, moving on to IWM Russell, beautiful recovery, 2.32% to the upside. So Russell desperately trying to get back the daily uptrend right here. So they had the daily uptrend. Heck of a move to the downside right here. Usually you're expecting at this point the bears to set the lower high into lower low conversion, but the Russell trying its best to defend this area, guys. The chart is extremely messy. Why? We're in this nasty area right here. We've been talking about this zone for a while. 201 down to about 195 has been previous support. Resistance, 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 and now still acting as resistance. So until we get a break and close above, we can't be confident in saying that bulls have really captured this area and are ready to take the higher levels yet. So I need to see a break and hold above on a weekly time frame above at least $200 to be able to then break out, retest this zone. That would be a beautiful trade for the entry right now. As of now, still caught in kind of a little bit of a middle ground. Remains to be seen, can the bulls pull off potentially the tightening range? A V shape would be your best case scenario, obviously, but when the bears take back so much of a move, guys, in one day, usually it does end up at best, a tightening range. At the worst case scenario, lower high, lower low. But for now, we're good. Keep an eye, same as the rest of indexes. Yesterday's low becomes your line in the sand. Higher low, flush this, it becomes a daily downtrend, and then we're just in for further weekly tightening up of this range that we've been stuck in. Target your lower level right here, 193, 12 EMA, crucial area not to lose. If ever we lose this in the coming weeks, you guys know my narrative. I am buying it down here, 187 down to 181. And now lastly, the Dow Jones recovering nicely after yesterday's flush. So Dow Jones holding up the 12 EMA, similar to financials, similar to healthcare, right? Very, very strong area of defense, right? The 12 12 EMA and now starting to try and recapture it. But Dow Jones not recapturing much of the move of yesterday. You can see they're trying to reset the hourly uptrend to the upside. So now that we have our hourly uptrend, our daily upswing is in motion at this point. And since they lost the daily uptrend, right? We lost the daily uptrend, loss of your lows right here, 38,200-ish, this low right here, lost it yesterday. Will be up to the bulls to prove to us, can they set a V shape in motion, potentially eclipse the all-time highs, reset the daily uptrend, or will we just be in for setting a lower high into lower low? The worst case scenario, which is what I want to set in motion for you guys here. If we do get a daily downtrend, where are we looking for expected consolidation? 37,200 is going to be the line in the sand level. Weekly consolidation could be inevitable in the next couple of weeks if the markets start consolidating as we've been expecting. At the first line of defense, 37,800 should line up with your 12 EMA. Dow Jones usually isn't that volatile, so if it does pull back, I am expecting a fairly shallow pullback, most likely into this most recent area that was support, right, which should be now acting as resistance in this little pocket right here. That would be a very beautiful little sell-off by the Dow Jones here from the all-time highs, maybe down about 3-4% for some discount shopping. Now moving on to crypto, and then we'll do big tech stocks. So crypto, look at Bitcoin on an absolute tear right now. So now for about the 10th trading day in a way, putting in new highs every single day at this point. Daily uptrend in full control by the bulls. We're breaking through our area of resistance. You saw that this area right here, all the way 47 to about 52, is pretty much your last area of consolidation before we start talking about the 60K level, which is going to be huge, 60 to 65K area of all-time high resistance. At this point, guys, if we can close the next week, that closes on Sunday, if we can close above here, we will, on any pullback, be looking at this area to be acting as new support at this point. So the 52 down to 47 will be newfound support. Bulls really performing an unlikely feat here, right? So we had a weekly uptrend, loss of the weekly lows right here, which means they lost the weekly uptrend temporarily, and then they V-shaped it back. This is the most improbable scenario, but the bulls still pulled it off. Very good for them. It is crypto. It's very volatile. The obviously the RSI won't mean much because it is crypto, guys. These things can stay overbought, just like NVIDIA can stay overbought for quite some time. So I won't really be using the RSI, but momentum is very good. MACD still pushing higher on the monthly as well. Momentum very, very healthy. RSI not overbought on the monthly yet, but even on the monthly, guys, it can get extended for so long and just continue to push. Momentum on the MACD still looking bullish to the upside, and monthly uptrend simply continues on Bitcoin at this point. No red flags, remains a hold for me. Very tough for me to buy some Bitcoin up here. I would rather wait for a bit of a consolidation dip, right? Establish some newfound support and then go shopping. I'm happy I was able to pick up a little bit of Bitcoin when it was back here. Most of the Bitcoin that I picked up was pretty much earlier back here between 25 and 30,000. So now I'm just looking to increase my holdings ever so slightly and add some to the trading account, but very tough to start a new position on Bitcoin here. I would be waiting for a little bit of a pullback personally. If we can see 47, 46, maybe even down to 45 on a wider scale pullback, if that happens, very juicy buying opportunity. Now moving on to Ethereum. Ethereum, much of the same. Ethereum now breaking through our level that I was looking out for here, guys. We actually cracked this 25 to 27 area of resistance. The next area of resistance now all the way up to $3,500. So a little bit of a ways away still on Ethereum, but just to show Ethereum bulls are in full control. Ethereum, unlike Bitcoin, never lost the weekly uptrend. So weekly higher low was set. Weekly trend continuation at this point, right? Daily uptrend as well is absolutely beautiful. As soon as the bulls top out this move, how do you know the move is topped out? It'll be a significant loss of your hourly trend at this point, loss of the 4-hour trend too. So as soon as this move tops out, you're looking for a daily higher low. Pretty much now going to be looking at this area, 2585. Confluence with the moving averages should be acting as a first line of support if ever the move tops out and we pull back. Momentum is looking absolutely beautiful as well on the MACDs across the higher time frames, right? Weekly uptrend, daily uptrend, and monthly uptrend is still in motion at this point too. So let's just keep an eye, guys. 33, 3,500, next area of resistance for Ethereum. I wouldn't be opposed to buying Ethereum even at these levels, just because in my personal opinion, Ethereum will run more than Bitcoin on percentage basis from current levels between now and the end of 2025, not 2024, but 2025. I do believe Ethereum is going to really outpace Bitcoin in that respect. Hasn't happened yet, Bitcoin is still a leader, but I do expect Ethereum to catch up and catch up very, very aggressively here, especially when rates start coming down. Looking very good. Bulls are in full control. The big time ad for me, guys, if now we can come back and retest this since we've broken a major area of resistance, I'll be looking to add on the pullback here, 2,500. Going to be adding a little bit to my trading account. Most of my Ethereum personally was purchased between the areas of about 2,000 and 1,600 in my long-term account. Now let's move on to our big tech names. That's not one of them. That's Airbnb. Let's move on to Apple here, guys, right? So Apple still struggling. Was a beautiful trade opportunity, guys. I did write the 180 puts for Friday because Apple was so oversold into the intraday period, right? So right around 1 p.m. is when I did do that trade. So Apple looking very good. Still struggling here, guys, right? Still struggling. The area to watch out for, 180. If we lose 180 lows, well, you guys know the drill. Daily downtrend is in motion. Weekly downtrend as well will be in motion. And then we'll just be looking for extended monthly consolidation, similar to back here on Apple. On the lower end of that consolidation can go all the way down to about 166. So this whole green box, guys, the buying zone, 180 down to about 166. Very juicy buying opportunity. Obviously, the lower the better. The lower we can move into here, guys. If I can see a 175, I'll be going extremely aggressively, but I'm starting to trade Apple as soon as these 180 strikes become available. For my percentage rules, I will be taking them every single time. Apple still battling right now. They still have a chance of setting the daily higher low for for new daily trend to the upside, but that will require a significant move. It'll require a break of 191 at this point. So just watch out for that. And these two yellow lines have been a big area of resistance for the stock. So very tough to say where price action is going to go on a day-to-day basis at this point, since we're stuck between so many overlapping timeframes. The only thing I can say, guys, at this point is if Apple does come down here lower than 180, I will be picking up some Apple. That is when I do think the shares will be in their final bottoming out process. And I mean, look, from the all-time highs, Apple's still representing a decent little discount here of about 8%, right? So down to the 180s will be a discount of about 10% from the all-time highs. And that is pretty standard from Apple. So that is what I'm looking out for them. In terms of the weekly, even if we lose the 180s, guys, yes, weekly downtrend, but everything's fine. The monthly bulls are still in control. It's just going to be a bit of sideways consolidation now for Apple as they struggle with a bit of revenue growth issues and things like that. Now, moving on to AMD. AMD breaking the tightening range to the upside at this point. Keep an eye, guys, 179.79, very close to there, 179.80-ish. Break this and you have a new daily uptrend in motion for your bulls. I loved to see this tightening consolidation range at the top end of a weekly move. That's what you want to see. When the bulls put in a heck of a move, how much do the bears consolidate? Only 38% of the move. That is really, really good for them. They also have been using, for the past 3-4 weeks at this point, the previous all-time highs as an area of pullback. So AMD looking very, very good. Slightly cooled off the RSI, but still overbought. The daily is looking fairly good, however. So AMD will be on the watch. Tough for me to buy this stock up there. I personally don't like the valuation that much. I love the company, but just don't like that they don't have the fundamentals to be backing up their share price right now. It ran a ton. I loved AMD back in the lower 100 area, right? But now the problem is they're at 180 and they have the same fundamentals as they had back here in October. So still not realizing those earnings per share or revenue from their data warehousing services, cloud management services that they're doing in competition to NVIDIA. NVIDIA has already started realizing that revenue and earnings expansion for the past 3 quarters. AMD is literally getting into it now. This will be their first quarter where they really start ramping that stuff up. So it remains to be seen how much of that can they bring to the bottom line, but looking very good. Daily bulls almost back in full control. Obviously, line in the sand level remains put at 163.60. Break that to the downside, daily downtrend, and just continued weekly consolidation. Bulls with so much space, guys. Anything over a 134 is just still weekly healthy consolidation. Previous all-time highs still acting as decent support, and your 12 EMA curling up ever so slightly to just rejoin this area as a bit of confluence area. So AMD, bulls looking very healthy, no red flags. Now moving on to Amazon. Amazon also recovering nicely today, 1.39% to the upside, And Amazon, we were looking loss of the daily uptrend, but the daily downtrend was not set. For a daily downtrend, you need the lower high lower low, but Amazon is looking very good at this point. So it remains to be seen. Can the bulls continue this hourly uptrend to the upside? If the markets fall apart tomorrow, Amazon will likely follow suit, reset the hourly downtrend, and then we will get our lower high, lower low conversion, daily downtrend into just further weekly consolidation. Weekly uptrend is beautiful on Amazon. Any consolidation is just to buy the dips. If Amazon comes down to 160, I will aggressively be playing options once again. Anything above 144, just looking for a weekly consolidation. And to the upside, guys, is going to be the top end of our all-time high range, which is about 177, and then topside targets of about 187. But this 187 zone right here should be a fairly tough area for Amazon to be cracking right now. So that being said, daily bulls not looking too bad. Just watch out for this. They can obviously V-shape this if the markets are good. But if ever we lose this, guys, do not get worried. That is why I'm presenting you all these downside scenarios for the markets, just so you won't be worried. Just always remember who's in control. And in this case, it's our long-term bulls. So the dips are for buying. Now moving on to Google. Google looking good as well, kind of hesitating here in the middle. So Google, I'll quickly remind what happened on this chart, right? Lose the daily uptrend after your earnings. They lost the lows, set the lower lows right here. Now it's been in this process of trying to reset that. We were looking at the size of the bounce. The size of the bounce was very juicy, almost 70% worth of bounce. Sets the bulls up nicely for the space to set a daily higher low and go for that trend change. Now that's exactly what they're trying to do. Look at this. Trying desperately right now to recapture. Well, Google right now is down about 1.58% in the after hours. Didn't see some headlines right here. Oh, the New York mayor suing these social media firms. So that's pretty much, that was some headlines throughout the day. They said they're going after Google, Facebook, Snapchat, a couple of them. So I guess they're dropping a little bit intraday, or we'll see how they open tomorrow there. But Google, perfect example, right? Just looking for the daily higher low. Need to protect this area right here. Need to try to set the daily higher low and then potentially go for the daily trend change. But if for ever which reason we trend lower, down back into this 141 down to 138, I will be aggressively playing Google stock in these lower levels. Why? Just a beautiful weekly uptrend at this point. Beautiful support zone right down here. Been a very big area of resistance in the past. Should be acting as previous current support right now too. And just a tightening range at this point for the past couple of weeks after their earnings. So Google looking very good. The valuation is amazing. The bulls are just caught in between two places right now. There's no trend set right now. The bears don't have a downtrend and the bulls don't have an uptrend. So kind of in between. When that ever happens, just focus on your longer term timeframes. Who's in control, and that's when we have a bullish lean. So any which one of these dips coming down to big support areas should be good for a buy. Now moving on to Meta. Give me a quick second. I missed the coffee sip on Google, so we'll have to do it on Meta. Now, Meta performing nicely, guys. Back up 2.86% to the upside. Nothing can hold Meta back. Meta performing extremely good in light of yesterday's drop here. So Meta, same thing, right? They were trying to set the daily downtrend. Didn't quite get it. 452 was the line in the sand that we were showcasing yesterday. So still a little bit of a tightening range at the top. Not much price action data. For ever which reason we lose these lows into the coming days, not that big of a deal, guys. Daily downtrend, yes, but beautiful area of weekly consolidation. Meta still extremely overbought on the weekly at this point. Any pullback on the weekly is just going to be for a higher low, anything above 340, looking for a weekly higher low for further trend continuation. Meta for me, I can only play this stock if we get closer to about $420. Even if the valuation right now is not that bad, and I'll be the first to admit it, it's not that bad. I just want to be a little bit more greedy, guys. I have a big problem with buying stocks when they're in heavy overbought conditions like this on the weekly time frame. So just keep an eye on that for Meta. Moving on to Microsoft now. So Microsoft, 0.78% to the upside, performing well. We were looking, can Microsoft protect this daily uptrend similar to Meta? They did not lose it. 403 was your daily higher low. And now we put in a higher low once again, double bottom almost. So now remains to be seen. Will Microsoft set the lower high into lower low, or can we just potentially V-shape this? Keep an eye on your hourly trends. Now Microsoft finally getting the hourly trend change going. If we maintain that into tomorrow and Friday, well, it will just be business as usual for Microsoft. But roll over with the rest of the market into tomorrow, hourly downtrend, you will be looking daily high, lower low, continuation of the downside. At that point, daily downtrend just means weekly consolidation here, anything above 366. Very healthy weekly consolidation for Microsoft. Just this past week, yesterday's data and today, cooling off weekly RSI considerably. And now even some of your daily divergence is fulfilled as well. So we had a bit of divergence right here. Higher highs on the chart in terms of price action, lower highs in terms of the RSI, usually corrects in the direction of this divergence. And this was on the markets as well. SPY, QQQ, Microsoft, a few other names had this divergence. And now the divergence has been fulfilled with yesterday's drop. So it remains to be seen, will the bears follow through and give us some weekly consolidation, or will the bulls just overpower? That is going to be the question for tomorrow's trading and Friday's trading, not just for Microsoft, but also for the rest of the indexes as well. Netflix looking very juicy today, almost up 5%, making a second stab at trying to close a week above this 575 level. So after having been in daily consolidation for roughly 3 weeks since their earnings, we were saying that this daily downtrend is just a weekly bull flag. Consolidation here, sideways largely consolidation at the top end of the move. Watch, they let the daily 12 EMA moving average catch up, touch it, and then run. And now we're due for a potential second weekly leg higher. Netflix still dealing with this 575 area of resistance. We'll see if they can close a weekly candle above that area. Would love to see it for the end of this week on Netflix. Netflix looking very juicy. Weekly uptrend confirmed, weekly higher low. Now that we've cracked two higher high levels, this now becomes your weekly higher low, talking about 551 and daily higher low as well. So now any pullback, just looking for a daily higher low to set the daily uptrend. Would like to see them potentially pull a bit forward, pull back, touch 575. That would be a breakout, retest, and run further than this level. Netflix looking very good. Now moving on to NVIDIA. NVIDIA also looking very good, 2.5% of the upside. Nothing really to say about this stock here, guys. Overbought on the daily, overbought on the weekly. Everybody knows it. Tough to be buying up here. Earnings next Wednesday. We'll see what happens with them, but they have a ton of space to pull back, and that's what I do want to highlight here, guys. Anything above 605, just looking for a daily higher low at this point. Equally, anything on the weekly, anything above 478, just looking for a weekly higher low. So if earnings is a big time cue for the stock to drop off, maybe they're not necessarily going to miss, but maybe they just remove some of the growth expectations or whatnot. That would contribute to a significant decline in the stock. I'm not expecting it, but if ever it happens, just remember how much space NVIDIA has. We'll have to be patient with it, because if they do have a bad day on earnings, it's very likely that we may just get daily lower high, daily lower low. But as of now, bulls are in absolute full control. Limited price action before their earnings on Wednesday here. Future psychological numbers remain 750 and 800. Now moving on to Tesla. Tesla as well. Nice little day here today, 2.55%. Still trying to reset the daily uptrend here, guys. So after this low, higher low, lower low, now we got a significant engulfing bounce. 80% of the move created enough space for a daily higher low for daily trend change. For that to occur, need to see a break of 194. Break 194, that will be your first daily uptrend since the sell-off began in late December. So that should be notable to us. Also, a little bit of an inverse head and shoulders pattern right now. If that gets some lift, it will take us in to the daily uptrend at this point, and maybe even the gap fill of earnings. Next area of resistance, obviously 207. And then looking about 217. Tesla looking good, still battling with our area of support here, guys, right? So this line, downtrending channel line, which is about 170, and horizontal confluence of support, 180 down to 170. That is what is allowing Tesla to really start a bottoming out process in this area right here. And also they're kind of parsing through most of their negative headlines right now. So it may just be a bottoming out process. You can see daily MACD also crossing to positive, shows positive momentum for the stocks. Remains to be seen. Can they really do a good job of recapturing this hourly uptrend and maintaining that enough to set us into a new daily uptrend above here? At that point, we'll then look how much of this weekly move can we take back if we are to set up weekly uptrend. But for now, bears still in control, monthly downtrend, weekly downtrend as well, and daily still no daily uptrend. So daily uptrend is going to be step number one. Now moving on to Palantir. Palantir, 5% of the upside, acted as if yesterday did not even happen. So we were always looking for a daily higher low for further trend continuation. Seems as though we got it yesterday. Still no new higher high, so remains to be seen if that's going to be the case. But Palantir bulls looking very good on the higher timeframes. Now, just keep in mind, we are still in that area of trapped equity from the IPO, and a lot of people will be very profitable. So this is still a very big supply zone for the stock. Maybe a lot of supply of shares of people looking to sell. Now, that being said, weekly uptrend is very gorgeous at this point. Any pullback just going to be for a weekly higher low. I'm targeting this area, guys. $21.50, $22 is going to be my area. If we do pull back to that, that is when I'll be looking to be making a bit more plays on Palantir. It's the lower end of our previous consolidation range and also our previous 52-week highs. Now a bit too rich for me to be touching it in terms of the price action movement. A little bit of overbought conditions here on the daily time frame. So I will be looking for a pullback, but everything looking good here, guys. The key is going to be maintaining this hourly uptrend. As you can see, it's just been largely sideways consolidation. So if we do get a break of the highs tomorrow, then your new higher low becomes 23.33, right, for further trend continuation. Any pullback, just going to be looking for a higher low, anything above 23.29. Now, lastly, PayPal. So PayPal doing pretty much nothing, 1% still battling down here and the lower part of our levels here. So after this tightening range leading into earnings, breaking it to the downside, losing the daily uptrend at that point as well, break to the downside. Now the bulls are looking to set the daily higher low. So once again, I'll remind you how much of the bulls bounced in relation to this earnings drop. How much of the bulls bounced? 50%. Is it enough to guarantee the possibility of a trend change? No. But is it possible? Yes, anything above 50%, you give the bulls the possibility. Now, it's good that we're bottoming out in this previous area of big time support and resistance as well. Big chop zone, 60 down to 57. So it could just be a nice bottoming out area for PayPal. One thing's for sure, as long as PayPal remains in these lower levels, I will be playing 57, 56, 55 puts fairly aggressively. Since I sold my shares prior to earnings 63.50, we'll be looking to benefit even more from that cost reduction. And I do believe this is a very, very good area for PayPal nonetheless. Need to see, can the bulls get the daily trend change? That would be a break of Monday's high, 60.59. If we get that break here, daily uptrend, it means that the bulls have successfully protected the area that they could not lose. You cannot close a weekly candle, guys, below this zone right here, right? We do not want to close a weekly candle below 57.11-ish. So the bulls still trying desperately to protect that weekly uptrend to potentially make a stab at your higher $60 level. I will not be convinced at PayPal's ability to run until we break this almost 2-year downtrending channel at this point, and that will require a break and close above at this point of $64. So looking good. I like the valuation down here. Trade opportunities, yes, but are the bulls out of the woods yet? Not at all. So hopefully you guys enjoyed today's video. I know it was a lot, but there was a lot of things to cover, especially after the last volatile few days. So if you enjoyed the video, please consider dropping a like. Would really appreciate it for the algorithm. And also, if you're new to the channel, consider subscribing too. We do these daily market recaps every day where we do your technical analysis, earnings plays, and a bit of recaps here on my portfolio. No portfolio today, guys. I do have to run, have to get to the restaurant. It is Valentine's Day after all. And even though I got a lot of red for Valentine's Day on the markets yesterday, still need to obviously take care of the significant other. Now, in terms of that, guys, if you have any questions, as usual, I'll do the portfolio. Once again, I'll do it tomorrow, I promise, and Friday as well. There have been a few trades that I've taken yesterday and today, all of them performing very well, most of them very conservative earnings plays. So with that being said, if you have any questions, guys, please always feel free, leave them down below in the comments. Anything macro, technical analysis, if there's an earnings that you want me to cover that I didn't cover so far, please leave it down below in the comments, or options plays too. Love to answer your guys' questions. So see you guys tomorrow after the close. Peace.